Hey, it's Mike Lynch with AmeriFirst Financial, and it's time for your Monday morning mortgage update for the week of October the 18th. Hope everybody had a great weekend. The rain, the cool weather, fall is definitely in the air. It was a great weekend. And so let's talk about last week, what happened with rates and what we expect this week. So last week we actually saw rates get worse. Friday was the worst pricing we've seen in months. And two things really affected that. Inflation numbers, I talked about that last week. They did not disappoint, way up on the CPI, the Consumer Price Index, and the PPI. Really highest numbers we've seen in years. Big concern for rates because when inflation goes up, as we've talked about many times, rates go up. Then the other thing is retail numbers were actually quite positive. There were some good signs in the economy, and we know when the economy's doing better, rates typically go up. So we definitely are in an environment of increased rates, and we've been that way for the last few months. So what are we looking at this week? What are the three things? We're looking at the Fed, we're looking at central banks, and we're looking at manufacturing. So the Fed, we've talked about this for the last few sessions, is really starting to talk about tapering, buying less mortgage-backed securities, which is going to drive those rates up, and then they have to deal with inflation. Our Fed has really been downplaying inflation, saying it's not here to stay, it's not here to stick, but some consumer reports that came out last week, most consumers think inflation is here to stay. I've talked about this, businesses think inflation is here to stay. The increased prices that we're seeing, the increased wage inflation, the increased of product inflation, you know, the toilet paper roll costs the same, but it's not as many sheets on the roll, that type of thing. It's here to stay, and a lot of major businesses have said that. So that is really a main driving force. And now some politicians are starting to really push back on our White House and the administration that maybe they need to do something about this inflation, although I'm not sure what they're going to do about it. Second thing is central bank. So not so much our central bank, but foreign central banks, China and the Bank of England. So China is one of the top 5 economies in the world, and they are having some big concerns about some companies. A big one, if you haven't heard about it in the media, called Evergrande. It's the largest developer in the world. They're defaulting on debt. China's starting to bail them out. Does that sound familiar? And their rates are starting to creep up. And Bank of England announced that they're going to hike rates. Now, one of the reasons they are doing this is because a recession might be on the horizon in the next year or two. We know recessions are cyclical, they're going to come, and one of the main ways the Fed has to offset the effects of a recession is to raise the rates, to raise the prime lending rates. We know those rates are as low as they can be, so we've got to feel some pain. They've got to raise those rates eventually to be able to use that tool to offset any onset of a recession, which probably is going to be coming in the next year or two. At least that's what most of the experts say. So if the Bank of England is announced that they're raising their rates and China is indicating they're going to raise their rates, you know, those are the top 5, part of the top 5 economies in the world, and that is influential. That has an impact on what other economies are going to do. And then the last thing, the third thing, is manufacturing. Some manufacturing reports coming out this week. Man, if we show that that's starting to increase, you know, we still have those supply chain issues. There's no doubt about that. China has big supply chain issues, but if we start to see a bump up in manufacturing, that means economies are starting to make stuff. They're starting to get things out to the consumer. We're going to be able to start to buy things. That's good for the economy, and that's bad for rates. So moving forward this week, we see a lot more movement to the downside, meaning rates going up, than to the positive. So we're starting today very, very cautiously floating, moving into a lock position instantly if we start to see the market change. If you have any questions about rates, if your clients have any questions, feel free to give me a call. All my information is in this link. And if you have any comments, I'd love to hear them. Have a wonderful, productive week. We'll talk to you soon. Bye-bye.